Welcome back to The Explainer. So today we're diving into something that's honestly a bit of a wild card. We are unpacking a highly debated, incredibly high-risk approach to the markets sourced straight from the Wall Street Mindset blog. We're going to be demystifying their highly systematic, kind of intense TQQQ dollar cost averaging and profit trimming strategy. Now, if you follow financial markets, you already know TQQ is an absolute beast of an asset. People literally call it a widowmaker if you aren't prepared for the wild volatility. So this explainer is going to break down exactly how one structural, rules-based framework attempts to completely tame it. To keep our learning efficient today, here is our roadmap. We'll hit the 3x multiplier effect, move right into the volatility risk, map out the actual portfolio blueprint, dig into strategic dollar cost averaging, and then wrap up with profit trimming and exits. All right, let's just jump right into section 1, the 3x multiplier effect, and decoding what the ProShares Ultra Pro QQQ actually is. So just think about the sheer scale of the math involved here. You've got the standard QQQ ETF, which tracks the NASDAQ 100 index, right? It gives you a standard 1x return. A 1% market rise equals a 1% gain. Super straightforward. But then look at the dramatic swings of TQQQ. This is a leveraged ETF, engineered from the ground up to deliver 3 times the daily returns of that exact same index. If the NASDAQ 100 goes up 1% in a day, TQQ is designed to jump about 3%. But, and this is a massive flashing warning sign, if the market drops 1%, you are looking at a brutal 3% decline. The amplification works both ways, making these daily swings an incredibly aggressive roller coaster ride. You're effectively strapping a rocket engine to the tech sector. And that extreme daily amplification leads us directly into section 2, the volatility risk, and exactly why conventional wisdom tells you to stay far, far away from this asset long term. The huge roadblock here is a mathematical mechanism known as volatility decay. Basically, it's the negative impact of daily compounding on a leveraged ETF during a choppy, fluctuating market. Because TQQQ amplifies daily movements and the math resets every single day, the simple mechanics of compounding can actually cause the asset to steadily lose value over time, and that happens even if the underlying NASDAQ index just chops around and ends up exactly where it started. It's kind of like trying to walk up a downward escalator. It's a structural headwind built directly into the fund, which is exactly why treating this thing like a normal stock can be financially devastating. The source actually hits the nail on the head here, illustrating why financial professionals warn against holding this long term. They explicitly note this conventional reality, saying, TQQQ is generally considered a short-term trading instrument given its susceptibility to volatility decay and the impact of daily compounding. That's the widely accepted viewpoint, right? Buy it, hold it for a few days, and get out. But the Wall Street Mindset blog proposes a highly unconventional, deeply structural counter-approach to all of this. So how do you actually fight that math? Let's get into section 3, the portfolio blueprint, architecting a systematic counter-approach. Okay, brief pause here. I need to make this absolutely crystal clear, just like the source does. The strategy we're explaining today is strictly not financial advice. This is for informational purposes only, and it involves a very high risk of loss. We are just neutrally breaking down their mechanical framework so you can understand the psychology and the math powering it. We are definitely not suggesting you go out and trade it. All right, so the author kicks off this specific sample portfolio with a base capital of $10,000. They do note that this TQQQ capital represents just a smaller bucket of their overall trading funds, which makes sense. But grounding this explainer in a realistic $10,000 baseline gives us the perfect foundation to see how their strict, percentage-based rules actually play out in reality. It translates all that abstract risk into calculable dollars and cents. Let's look at the actual mechanics governing that capital, because it is rigid. They inject $1,000 of incremental capital every single month, structured as 2 scheduled $500 buys. On top of that, they execute daily buys representing 5 to 10% of the base capital, totally depending on the technical setup. But notice the heavy restrictions they apply here to completely strip human emotion out of the game. No buys near market supply zones. They literally refuse to buy at the top. Plus, they use cautious, staggered buys when the QQQ is trading below its 50-day moving average. But once it's trading safely above that 50-day moving average, they switch to aggressive daily buys. It's a highly structural deployment of cash designed to completely prevent panic buying or selling. Moving right along, let's unpack the mathematical engine that's actually driving those dip buys. Section 4, Strategic Dollar Cost Averaging. The blog makes this point with a lot of energy. Dollar cost averaging is essential. It is the absolute foundational mechanism, keeping this entire long-term strategy alive in the face of that massive volatility decay we talked about earlier. Psychologically, it forces you to lean into the fear. According to their framework, you simply cannot use this approach without aggressive DCA to constantly average down your entry points during a market bleed. So let's look at how they execute this in practice. Say your initial entry is 10 units at $60 a pop. The price drops? Well, you don't panic. You execute a price drop buy, picking up 12 units at $50. What if it drops even deeper? You hit a deep drop buy of 15 units at $40. You see the strategy here? By systematically purchasing more units at lower and lower prices, they dramatically drag down their overall cost basis. They are effectively taking the asset's extreme 3 times leveraged volatility and using it as a weapon to scoop up cheaper shares, setting themselves up for a massive rebound. Of course, aggressively buying the dip is only half the equation, right? Let's pivot to our final, crucial section, profit trimming and exits. And here is the million-dollar question we have to ask about this whole blueprint. How do you manage the risk of a continuously dropping average price? If you're out there constantly accumulating shares on the way down, absorbing all that pain, how do you actually capture the upside when the market finally bounces without getting trapped holding the bag? While they solve this by dynamically adjusting their exit targets based entirely on their average buy price. As their average buy price decreases, they widen their limit sell spreads. So for units bought at a deep discount, say your average is $40, they set a widened spread ranging all the way from $41 up to $80. Because the market is severely oversold at that point, they give the asset plenty of room to run and capture those massive relief bounces. But for units bought at a much higher average, say $70, they deploy a tighter spread between $71 and $90. They're basically aggressively setting limit sells ranging from a 1% profit all the way up to a 50% profit, constantly trimming their position as the price moves up, ensuring they actually lock in those realized gains. And there's one final rule to their blueprint, which is absolutely key. Always keep a few runners to capitalize on larger moves. By leaving just a fraction of their shares entirely untouched during that profit trimming phase, the portfolio ensures it doesn't miss out on those massive, face-melting upward tech rallies that the Nasdaq is famous for. It's a really clever way to participate in a parabolic bull run without risking the core capital. So we've broken down the whole shebang. The 3x multiplier, the very real danger of volatility decay, the rigid portfolio rules, and the precise mechanics of dollar cost averaging paired with dynamic profit trimming. It is an intense, completely mechanical system designed to tame an incredibly wild asset. Which leaves us with this final, really provocative thought to ponder. Can strict mathematical discipline and relentless systematic rules truly outsmart the inherent compounding decay of 3x leverage over a lifetime of investing? It's a fascinating debate for sure. I hope this explainer gave you the structured insights you need to understand both sides of the coin. Thanks for learning with me today, and keep questioning the mechanics behind the market.